In a moment of market volatility, conventional investment approaches may no longer yield the highest returns. For founders seeking capital, economic challenges like inflation and the rising cost of living, along with a shift in talent acquisition and retention, require a different point of view. Philipp Freise and his team at KKR are shedding light on how uncertainty can ignite innovation, creating fresh investment prospects and alternative fundraising strategies.
There's a lot of negativity when you look at the health of the markets right now. People are concerned about inflation, the cost of living, even attracting the best talent. But let's focus on the positives. Where are you seeing the most opportunity right now for investment in Europe?
Well, Michael, we are talking to a group full of entrepreneurs. And what's interesting about this current situation is that change and turbulence and chaos breeds opportunity and it breeds innovation. So that makes me optimistic. I think we probably have seen some of the best foundings and innovations during times like these, because when things are not the same way they were before, when things are changing, when there's real crises, then new opportunity exists by definition, and more differentiation as well results from that.
It is hard out there for founders, so what advice would you give them for those that are trying to raise capital for their new ventures?
So I would have three pieces of advice. When you build your business, be careful. You invest wisely, you build wisely, you scale wisely. So that's the first one. It's just going back to basics. The second one is don't be afraid of that turbulence. Resilience is really important right now. And then the third one, I talked about differentiation. What's really interesting, when there's differentiation in the market, you also find the best talent. Now's the time when people will be really discerning to look hard for your teams to find the best people. I would really focus on that.
Well, speaking of financing, you yourself and your co-head raised $8 billion earlier this year. How difficult was it for you guys, especially in this climate?
There's a whole new world out there where you cannot just go to the existing sources of capital, but you have to think about alternative ones as well.
And so speaking of alternative avenues, what were some of those alternative avenues that KKR did approach and find to help raise this capital?
I would say more generally, more broadly than KKR, there's a trend now in the whole investing industry to tap the high net worth retail channel. That is a very different situation from 10 years ago when it was largely institutional investors that we were targeting.
Is there any specific regions that you're most excited about that really wasn't on the radar maybe 5-10 years ago?
Clearly the Middle East is going through an incredible period now of wealth creation. Many down there are our partners, and that is something that is definitely also new.
If I'm a founder and I'm hoping to get on the radar of a KKR, what are you looking for?
We very much talk about entrepreneurial capital. When we invest in a company, of course, we look for the product, the market, for the ambition. But above all, we look at the founding team, the drive, the creativity, the team orientation, because we pride ourselves very much in our firm that we are team-oriented culture. We know that one brain cannot deliver what many brains can deliver. So the idea of working together is super important. We also value, I talked about it a little bit before, resiliency.
There's so many disparate stakeholders when it comes to running a business. What advice would you give a founder in handling so many disparate stakeholders?
Again, build a team. Can't do it all yourself. I cannot overstate the importance. I think from day one as a founder, you want to think about how do I spread myself with the right team. If you're great in product, then you get an operator in. If you're great in operation, get the product person in, get the finance person in. If you need to be in multi-territories, you want to have the local talent, etc., etc.
If I'm a founder, often I think an IPO is the be-all and end-all and the goal that I want to achieve for my company. Is that still the case?
I think in the 22 years that I've been doing this investing job, I've never seen as much interest of founders and CEOs and entrepreneurs that are actually public to go private, or that are private to stay private for longer. So it's maybe the exact opposite of what your question intended, and here's why. In these turbulent times, in these times of chaos, transition, and change, people realize that the capital markets, they don't bring you anything. Why? Because, of course, they bring you capital, but you get that in the private realm as well. So as an entrepreneur, do not be worried. Now's the time to hold conversations with the private capital providers that really bring more than capital, and we will help you get through this period. I IPO'd Trainline in the UK, for instance, in 2019, which was a seminal moment for the UK because it reopened the IPO markets. And then we had COVID. Of course, there was a massive panic around what does the virus mean, and the stock price collapsed. Then there was a change in regulation. All of these things, they probably could have dealt with much better in a private setting. So cut a long story short, nothing to worry about. It'll come back. But use the time to get prepared to be a public company a little later.
When we look at the different regions, America particularly, we've seen a drop of almost 50% of investment in startups in the last 12 months. Are you seeing the same sentiment in the EMEA region?
It's not surprising that we see that drop. Why? Because in the year before, we had that massive boom of unparalleled capital flying anywhere. And you will find that surprising what I'm going to say. I was a founder myself in 99, 2000, when there were no limits to capital. It's the worst that can happen. And when there's less differentiation in terms of what it needs to take that capital, there is just less hard work, there's less resilience, there's less ingenuity required. So in EMEA, the sentiment is exactly like the one in America. There's a scarcity of capital at this time. It just forces that concentration of mind to think about, with less capital, how do I get to the same outcome? With more guerrilla thinking, how do I get to the same product? So it's not necessarily a bad thing. It sounds maybe counterintuitive, but I think many of you entrepreneurs will realize this when we look back in a few years' time, that this was one of the most productive periods.
Has it changed the level of deals you've done this year, or have you been more cautious or overly cautious as a result?
So between April and November 2020, we invested 40% of our flagship European fund at the time, which was an activity level which was 2 times higher than we typically would have done in a given year. We dialed back the activity in the year after. So in 21, when there was this massive boom, we very much reduced our activity to very little. And now you're asking the most interesting question, because we clearly now are not in a boom phase anymore, but we are in this twilight phase, in this really interesting phase, in this adjustment phase. So there's lots of uncertainty. So I think the whole investment industry has really reduced its pace of investing, and so have we this year.
I think a lot of people will be very interested and surprised to know just how many family businesses and family-owned and operated businesses there are in Europe. It's quite a large market. How healthy is that sector? Because in North America, we don't hear a lot about those businesses, especially at scale.
So if you look at the numbers, Europe has 3 times more family companies relative to GDP than the United States has. That means that we are just not as disintermediated by capital markets as the US is yet. To give you an example, in 2009, we teamed up with Bertelsmann, the owner of Random House. They had just exited the music industry because there was a lot of turbulence, as you recall. But they wanted to go back in one way or form because it had been part of the family history forever. They didn't really want to take the risk doing it alone. So they teamed up with KKR. We did a 50-50 situation with them. And we built BMG, the largest independent music publisher from 2009 to 2013. That company, they bought us out later, is now probably the 3rd largest business in their family environment. So it's a good example of what's happening here, that we become partners to them to really make them valid and long-term prosperous for many years to come.
So when we look 12 months, 18 months into the future, what are your expectations for return on investments?
I talked about this twilight phase. I think we're almost through it. I would be very surprised if activity levels do not go back up significantly.
For someone who oversees $8 billion, you seem very calm. So I am curious, what keeps you up at night?
When you ask me what do I worry about as an investor, the Ukraine situation is not only tragic, it has a big bearing on all of us in Europe. I think Europe has gone through very well in terms of just weathering the storm in an immediate sense. But I do think that Europe is in a transition situation in terms of its business model more broadly.
Are you optimistic when you take a seat back and kind of look at where we are today and you look to the future? Are you hopeful?
If you fast forward for the next 10 years, I'm incredibly optimistic, actually, both in terms of our ability to cure cancer, in terms of our ability to connect poor regions of the world to the internet or to communications, etc. There's quite a few exciting developments. Yeah.